Let me just summarize this entire dilutive thing for you.
Okay.
While calculating diluted EPS, there can be three different possibilities.
Hmm.
The first one is that there are convertible bonds. The second can be there are convertible preference shares. And the third can be ESOPs. What are ESOPs?
I don't know.
Employee stock option plans.
Okay.
What are they? That
This.
that the employee will now have a right to exercise the option and get the shares in the company at a
Mm-hmm.
discounted price.
Mm-hmm.
Right? This is generally to motivate the employees. Okay. If if the question has convertible bonds, now what are the two adjustments that you are going to make? The first adjustment that you are going to make is that you are going to add interest 1 minus tax to the numerator.
Can you give me again what is the ESOPs? Employees?
Employee stock option plans. Employee stock option plans.
Okay. Okay.
Right? So the first adjustment that you will make here is you will add interest 1 minus tax to the
Mm.
numerator. And
Okay.
second, what is the second adjustment you'll do?
To see how many numbers of
Correct.
shares.
Add the converted number of shares to the denominator. Understood?
Yes.
Good. If you have the preference shares, the adjustment to be made in the numerator will depend on what is given to you.
Hmm.
If net income is given, what will you do if net income is given? You don't add back the preference dividend. Remember, we are
Yes.
adding it back to reach the net income. If net income is given to you, then you will not add it back. Right? If net income to common shareholders or common stockholders is given, in that case,
I will add.
you are going to add back the preference dividend. And the second adjustment that you will make, add the converted number of shares to denominator. add the converted number of shares to the denominator.
Okay.
Right?
Mm-hmm. Clear.
Okay. In case of ESOPs, employee stock option plans. Now the stock, why does the company give the stock option? We'll also talk about ESOPs once we reach that chapter. But
Mm-hmm.
why does the company give ESOPs in the first place? It may be to retain the employees. It may be as a part of compensation. It may be as a motivation thing, right?
Mm-hmm.
Now, what ESOP does is ESOP gives the employees a right that once there is a some period attached to it called vesting period. Just forget it. We'll talk about it once we reach that chapter. So ESOP gives employees the right wherein they can get X number of X number of equity shares at a discounted price to the market value.
Mm.
Okay,
Okay.
this is the concept. Now, do you think in case of ESOP there is any adjustment required to the numerator?
Numerator maybe no, but denominator
No,
absolutely
correct.
yes.
No adjustment. No adjustment in numerator. No adjustment in numerator. Now, but in denominator,
Mm.
add the converted number of shares to, to the denominator. Now, the question is how to get the converted number of shares. How to get the converted number of shares. How to get the converted number of shares. Right? So, how do we get the converted number of shares? Is we follow a method known as the treasury stock method. We follow a method known as a treasury stock method. A
Okay.
treasury stock method. What is that option? I mean, what is this treasury stock method? I'll explain as I write. All right. So, what do you do in the
Okay.
treasury stock method is if the option is in the money, if the option is in the money, that means when will the option be in the money? When will the option be in the money? When the exercise price is less than the market price. When the exercise price is less than the market price. Now, what does that mean? That means if I have been given a right to purchase the share at $20, the price in the market is $15. Will I exercise my option? No. I will say, why will I pay the company $20 if I can get the same shares at $15 in the market?
Mm.
Right? So in this case, the option is set to be out of the money. There is a term given to it, out of the money. But if the price is $50, if the market price is $50, now I will exercise it at 20. because I am getting a benefit,
Hmm.
right? So only if the exercise price is less than the market price, the option becomes in the money,
And okay.
right? So if the option is in the money, calculate. If the option is in the money, calculate the cash received by the company. Calculate the cash received by the company. What is the formula? Number of shares that I will get multiplied by the exercise price number of shares that I get, multiply it by the exercise price. Okay. So this is the cash that will be received by the company. If I decide to exercise my option, I will have to pay the company, right? So I will have to pay $20 to the company. Let's say
Uh,
100 shares. So I will
I'll
get
take the lower.
2000. Sorry.
I will take the lower.
No, you will not take the lower. You
Mm.
will only do this if the exercise price is less than the market price. And you will
Ah,
use the exercise price,
okay.
right?
This is the
Now,
money. Okay.
in the money. Now, now this treasury stock method says
Mm.
whatever amount of money will be received by the company, what will the company do with it? The company will buy back the shares from the market. The company will use that money to buy back the shares from the market at the market price, right? Because if the company starts just giving it out, the control will get diluted. So the company has to maintain the control also. So the company will use this money to buy back the shares from the market.
Okay.
So the cash received is used to buy back the shares from the market at the market price. And how will you compute the shares to buy back? This is the cash received in step one, and you divide it by the market price. Divided by the market price. Let us try and understand it by taking an example. Suppose the company has given you an option that you can get 100,000 shares at $20 per share. The market price is, let's say, $50. Is the option in the money?
Yes.
Yes. So how much will be the cash received by the company? How much money will the company get? The company will get
100
100,000 shares
by 20
multiplied by 20,
to 100.
200,000. Okay. Now the company will use this 200,000 to buy back the shares from the market.
Mm.
So how many shares to buy back? How many shares the company will buy back?
Oh, The market price is
50?
40,000.
So 200,000 divided by 50,
2 million.
4,000. Right? 200,000 divided by 50 is 4,000.
2 million. 2 million from the beginning.
Oh, it's 2 million?
Yeah.
Oh, my
So
bad. It is 2 million. 2 million divided by 50 will get 40,000. Awesome.
Okay. This only to calculate based on the in-money case.
Only. It will all happen only if it is in the money. Because people will exercise only if it is in money.
Okay.
Right? Now, step number 3 and the last step. The incremental number of shares. Calculate the incremental number of shares. How do you calculate? Shares converted
Okay.
by issuing the options minus the shares buyback as per step 2. In my case, how many shares? I converted 100,000 shares. I got 100,000 shares minus 4,000 is the buyback. So I get 96,000 shares. Incremental shares is 96,000.
Wait, again? We issued 100.
100,000. 4,000 I buy back. So what is the additional shares that I am issuing?
40,000 buyback.
Sorry, my bad. I don't know why I'm taking 4,000 every time. 40,000 buyback.
Okay.
It is now 60,000.
60. So the
Right?
60
Incremental is 60,000. Now,
which one
tying
I
it up.
put? The 60?
Yes. Tying it up. This incremental number of shares is what will be used in the formula.
Yeah.
Clear?
Yes.
Good. Okay. So this treasury stock method we have computed, we have done. This is the same. And just one more thing we have to do is this. The calculation of diluted EPS does not assume the conversion of anti-dilutive securities. This we have already seen.
Which page
Right?
is this? Okay. I found it.
This is ninth.
Okay.
Okay. Now, there is one more complication that will be there. you will be able to do this on a standalone basis. Standalone basis means if the bond is given to you, no problem, you will do this adjustment for convertible
Mm.
bonds. If convertible preference shares is given to you, no problem, you will do this adjustment for the convertible preference shares. If
Mm.
ESOPs is given, no problem, you will do the adjustment for ESOPs.
Mm.
The problem comes
If
when
three
all
of
of
them
them
yeah.
are given together, right? And it is not as simple as it looks. So let's take an example. When both convertible bonds and
Convertible preferred.
convertible preferred stock is given, then what should we do? We are going to follow the steps.
Okay.
Also, this is not given in your book. Make sure that you are doing this. This is a hack to do this question in the correct manner.
Mm-hmm.
Step number one, find the basic EPS if not given. If the basic EPS is not given to you, find the basic EPS.
Okay.
Second step, calculate the numerator and denominator effect. Calculate the numerator and denominator effect of both convertible bonds and the preferred stock individually. Calculate the effect individually. That means if the convertible bond is given to you and the interest after tax is 7,000, right? So that means you will have to adjust 7,000 in the numerator.
Mm.
And let's say the convertible number of shares is 5,000 shares, right? So what will be the numerator and denominator effect? Interest component 7,000 divided by
Number.
the shares
Mm.
5,000. So you will get a ratio. So you will do this individually for convertible bonds and individually for preferred shares,
Mm.
preferred stock. All right. Don't take the entire computation. Don't take the entire computation. Just take the effect of bonds. That means interest divided by the
Number.
number of shares that will be converted.
Mm.
Right. Now, we will start with the smallest ratio. We will start with the smallest ratio of step two. You are doing this individually for bonds also and for preferred stock also. Whichever
Mm.
gives you the smallest ratio, you will start with that. Right?
Okay.
Suppose preferred stock gives the smallest ratio. Suppose preferred stock gives the smallest ratio. We are going to find diluted EPS by only taking the preferred stock into consideration.
Mm.
That means if preferred stock out of bonds and preferred stock, if preferred stock effect gives the lowest ratio, we will compute the diluted EPS by only taking the effect of preferred stock.
Okay.
Okay. Then if diluted EPS in step 4, if the diluted EPS in step number 4 is less than the basic EPS, that means it is dilutive, right? If the DEPS is less than basic EPS, that means it is a dilutive effect, correct?
Mm.
If it is less than BEPS, include bonds as well and compute DEPS by taking both preferred stock and bonds. Now, what does this mean? This means that if the DEPS, when you just included the preferred stock, if it is less than the basic EPS, that means it is dilutive. That means we can go on.
Mm. So this is steps only to double check if it is diluted or no?
If it is diluted or not, yes.
Okay.
Right? If it is diluted, now it's fine. We can use it. We'll now bring in the bonds as well.
Okay.
Then, if the diluted EPS in step number 5 above, that means after taking both preferred and as well as bonds,
Mm.
if it is less than your basic EPS, if it is less than the basic EPS, it's fine. You are going to report the basic EPS. Sorry, you are going to report the diluted EPS. But if the diluted EPS in step 5 is greater than basic EPS, that means now the bonds is anti-dilutive,
Mm.
right? Do not continue. And the final diluted EPS is equals to what we calculated in step number 4. Understood?
Yes.
Just read all of these steps again. Please process this
Okay. So
and
we
ask
will
me if there is any confusion. Yes, go on.
okay. What we did in step 4 that we only calculated based on what we had lower, either preferred or bond. For
Correct.
example, if bond is lower, then I did the next step, adding up the preferred, and it was higher than the basic, then only one of it will be diluted, not both.
No, look at it this way. Suppose
Yeah.
you calculate the ratios for preferred stock and bonds. The preferred stock ratio comes out to be 1.5. The bonds comes out to be 1.9.
Hmm.
Which one
I'll
will you
take
include?
1.5.
You'll go with preferred stock first,
Hmm.
right? You'll calculate diluted EPS considering only the preferred stock,
Okay.
right? Now, suppose basic EPS is 1.25. Just suppose basic EPS is, oh no, suppose the basic EPS is 2.1. Okay.
Hmm.
Now, you are going to calculate the diluted EPS. If the diluted EPS, if it is less than basic EPS, then you will also include bonds
Hmm.
in the calculation, right?
Yes.
If the diluted EPS after including both of them is still less than basic EPS, then it's
Then don't
fine.
be with it.
Then it's fine. You can report this.
Okay, it's clear.
But if diluted EPS after including both of them is higher than the basic EPS,
I will
then you
only
cannot
respect it.
include the bonds. Then what you report is this step.
Clear.
Clear?
Clear.
Sure?
Yes.
That was the concept of EPS. How was it? Good? Easy?
Heavy, but it's okay.
Heavy, but easy for you.
Yeah,
You'll be able
inshallah,
to
it's
do it.
easy once we answer the questions.
Right. Okay. So let's do one thing. Let's take a 15-minute break here. Once we are back from the break, we'll take up questions from these two topics.
Okay, sure.
All right. And see you in 15 minutes.
Inshallah.